Entrepreneur MBA podcast purpose is to help existing business owners grow their companies past the 10 million in revenue per year benchmark. Here is your host, Stein Halasnik.
Welcome, everyone. My name is Stein Halasnik, and I'm co-founder of Financing Solutions. Financing Solution provides easy to set up lines of credit for small businesses, and I will be your host for today's Entrepreneur MBA podcast. If interested in learning more about a business line of credit, which I would highly recommend, I've had it my whole career. I always made sure I had a backup plan. Please visit us at fscreditline.com. That's FS as in Financing Solutions, creditline.com. Over the last 25 years, I have built 6 companies in the $5 million to $25 million range, including 2 companies on the Inc. 500 fastest growing companies in the United States. I love learning from people with business experience, and today I'm excited to be speaking with Andrew Schwartz from Stein, Sperling. Andrew is a principal in the business law department of Stein Sperling in Rockville, Maryland-based law firm with offices throughout the Washington, D.C. metropolitan area. Andrew concentrates his practice on business, employment, and real estate law, which includes the drafting and negotiating of contracts, partnership agreements, including operating agreements and shareholder agreements, business entity formation and corporate governance, business disputes, and buying and selling businesses. He is frequently asked to speak to business owners on topics such as business entity choice, navigating business controversies and disputes, and practical and legal aspects of business succession planning and employment matters. Andrew, welcome to today's Entrepreneur MBA podcast.
Steven, thank you for having me. Happy to be here.
Good. Before we even get to today's topic, which is a very, very robust topic, if somebody is in another state like California, does it make sense for them to kind of contact you?
Yes, and we can help. You know, we have attorneys that are licensed all over the country, and we can certainly help advise on the issue. If it becomes a local issue, we may need to get local counsel involved. But on general business advice and matters, we can help.
Okay, good. So today's topic is successful business through growth, management, operation, and succession. And so, let me start off by asking you, you work with a lot of small businesses, correct?
Yes, that's correct.
From an attorney standpoint, what's the biggest mistake that you see that small business owners make from your observation?
Sure. Great question. Usually it's not getting the right entity set up the proper way at the outset, and if you have partners, not having the proper agreements, whether it's a shareholders agreement, an operating agreement. I've seen way too many times people are excited about their new venture. They just go online, do some Google search and say, all right, this looks good for the type of entity, start operating, and then for whatever reason, think, oh, I need to go speak with an attorney. And a lot of times it's not the proper entity for what they're doing, or they don't have the proper agreements, like I said, with their partner. And trying to undo that or unwind that early on ends up costing them more money than if they had reached out to an attorney to begin with. To do it the proper way, it would have saved them the time and money and the frustration.
What have you seen the ramifications of not having a company proper? Now, when we talk about set up properly, we're talking about, is it an LLC? Is it an S Corp? Is it a C Corp? What is it? What are the ramifications that you've seen in practicality of a business that has grown and it wasn't set up correctly? What happens?
Sure. So for me, the most often issue I've seen is when they go to sell, right? Or bring it on a partner, is they've been operating, in under one type of entity, call it a C Corp or an S Corp, and they go to sell, or they're bringing on investors. And in some instances, it's difficult to bring on investors based on the type of entity you have. There's certain restrictions if you're an S Corp, for example. I've also seen people have real estate investments and they own it as an S Corp or a C Corp. In reality, most times if someone's holding real estate, it should be in an LLC. So before we can take the next step, whether it's a sale or bringing on investors, we sometimes have to backtrack and unwind what's been done for a period of time and how they've been running the company, and kind of restructure it the right way so that we can then take the next steps for a sale or bringing on investors. So, and certain investors only want to invest in a certain type of company. And so if you're not that type of entity, when you start to grow, and yes, you can make changes along the way, but when you're bringing on investors, it takes additional time, documentation, and costs to do it that right way to take on that investor's money.
So give me an example of let's say somebody is an S corp already, or they could be whatever
Right.
type of corporation they are, and they have to make a change. I mean, as me, I always just plow forward. So I'm like, okay, I'll worry about that later. All right, which is probably 90% of the business owners out there, right?
Correct.
It's why we do what we do. And so how difficult is it to switch a company?
Sure.
I mean, can't I just take the LLC, open up another company with an S corp or whatever, and just start doing business under the S corp?
Right. So potentially, right? So the first part is what entity we need to identify what entity we currently are and what is it we need to be. And under each jurisdiction, there's usually statutory provisions that provide for how we convert, for example, from a partnership to an LLC, all right, or a corporation to an LLC. Not all jurisdictions permit that. Okay, so depending on where you're doing business, you have to go through the legal requirements and statutes to see if we can do that. Now, to answer your question on if we've got an LLC and I just want to move the assets over, the issue is it sounds simple to just form a new entity and start operating. And believe me, plenty of people do. But the issue is you've got potentially assets owned by that other entity. So how do we move those over, right? There's tax consequences. So we can do what's called a contribution agreement or a merger somehow and make it a wholly owned subsidiary. But each of those requires certain steps, certain legal documentation, and also consultation with client's accountant to make sure there's no adverse tax consequences. So we got to be mindful. Believe me, a lot of people just move it, start operating, and then, whether they need bank financing or they have a contract or they want to sell, that's when they realize, I didn't do this right. So it could be assets you have, contracts, for example, government contracts are assets. And so you may have to what they call novate, assign the contracts over to the new entity. You need to make sure that you've got insurance for that new entity. So there's a whole host of issues, including licensing, things that you need to think about more so than just, hey, I was operating under this entity, now I'm going to operate under the other one.
So let's take this one step further, and that is you already have an existing business, $3 million in sales, in revenue. And so from your experience, what have you seen most often? Forget about the incorporation for a second and how it was incorporated. What do you see the biggest issues that usually come down to? Partner agreements?
Yep.
Okay.
Yeah. So the big and part of what I do a lot of is business dispute work, right? And so we want to take preventative action to grow the company and be mindful of that. So the biggest issue I see is not having the right operating agreement or having an agreement that leaves out a whole host of issues. And so it's a partner disputes. When the companies are growing, they're becoming successful. Undoubtedly, if there's two or more people, one person is usually working harder than the other, right? But that they're splitting the profits and distributions equally. And at some point in time, the person that's taken 50% of the profits, but is working, 90 hours versus the guy working 40 hours, there's going to be an issue. He's going to be upset and say, I'm pulling all the weight. Why are we sharing the money? And so the operating agreement addresses that, right? And how do we deal with disputes? And can we make disproportionate distributions to counteract the value someone's contributing? So that's one part of it, right? Partnership disputes. And the other one is just not even the partners, but having the right management employees, the right people running the company and managing it so that you can be out there developing the business. If you're in the business, in the weeds on a day-to-day basis, it's difficult for you to be growing the business as well. And so important to have key people, employees that you trust, that are committed to you to help grow the business with you.
I assume that when people are calling you a large majority of the time, well, I shouldn't say that. Is there usually a problem when they're calling you?
Sometimes. So it's about half and half, right? Some people call me and say, oh, I didn't do this right, or I've got an employee issue, a partner dispute. We don't have any documents. On other instances, it's someone that has done some research and says, you know what, before I go down this road and start, I need to speak with an attorney, kind of figure out what I need to be doing and thinking about. So I would tell you it's about half and half.
Yeah, like what is your? I know I read what your specialty
Sure.
is, but what do you tend to do the most type of work in?
Right. I would say ownership and operating agreements, shareholder agreements. So essentially partnership agreements. We act as outside general counsel. I act as outside general counsel for my, small, mid-sized clients that don't have their own in-house counsel. And we'll do mostly at the beginning shareholder agreements, succession plan, right? We've got family businesses and they want to bring it to the next generation. And how do we do that, right? Through gifting of shares, purchasing of shares. What happens if there's some siblings involved in the business, some may not be? How do we address the family dynamics to keep the company growing through the next generation? So there's a lot of that.
When you've come across a lot of different business owners, and from your perspective, I think maybe sometimes you can see that this owner is on, like this one owner is on the ball and another one is kind of loosey goosey, not really. And I don't mean from a legal standpoint. I just, so from your observation,
Yeah.
when you look at somebody who's running some businesses that are really, really good, what have you noticed about them?
Right. So I think, like you said, there's different personalities, right? I've worked with type A, hard charger, everything's buttoned up, and they've been successful. I've also worked with in certain other industries where they're more hands off and, like you said, loosey goosey, more laissez faire, but still have put a team around them that can advise them and that they trust to really run the day to day manage. I have one client in particular who doesn't even have his own laptop. Hugely successful business, but has hired 2 to 3 people to manage the day to day, keep him informed, and he relies on his professional advisors, me as his attorney, his wealth manager, some insurance people. And so the key for all of these, whatever their personality is surrounding themselves with the right group of people and advisors that they can rely on to make the decision. So, each person is different in personality and how they approach their, business and dealing with their employees. But across the board, I've consistently see, a set group of small team members that they rely on to help manage and run the day-to-day business.
Yeah, I'm going to add to that too. I know a lot of business owners, right? And I agree. I echo your comment that every single one of them runs their business in a different way, right? And there's kind of like, I remember when I first started my first company, I before I started it, I was like, okay, let me learn about how business owners work and how they the best ones, what they do, and then I'll mimic that, right? And I think there is some truth to that. I mean, it's I call it high probability, and that is what are the things that I need to be doing that give me the highest probability of success, right?
Right.
So an example would be, right? If someone has a business that's 10 years old and you don't look at your financials on a monthly basis, uh, I don't think you're going to grow to be a
Right.
very good company, right? It's a given, right? Now, you might find that 1 out of 100 or 1 out of 1,000 of a person who doesn't look at their financial statements and grows a bigger company. I don't know. Even then, I think it's going to be rough. So
Right.
you try to do the hybrid. So, but my point being is this: there's a lot of different types of owners, which I agree with you on. But there are certain things that are a given, right? That allows you to jump to the next level. And so let's jump really fast forward to the people that you've met who have been who build their companies to sell,
Hmm.
right? Or are selling their companies, right? I mean, what percentage of the times have you actually had conversations with people who say, "I want to sell my company, but I'm not doing it right now. What should I be doing?"
Yeah. So that conversation since COVID has started has significantly increased.
Wow.
So, I do a lot of M&A work on a daily basis, but I think throughout COVID, it made certain of my client business owners reevaluate what it is they want to do with their life. And some of them really flourished through COVID, certain industries, some struggled. Uh, but a majority of mine, given the nature of the industry, have really grown exponentially. And so I think they think, there's people out there with a lot of cash and looking to acquire, and the values of these businesses have also significantly increased. And so that conversation has come up a lot more recently. And so what we talk about is, are you prepared to sell, right? What is it you're looking to do? Just get out of the industry completely? Are you looking to bring on a partner and so that you can step back over a period of time, or just an outright sale? And so we need to position, is the company ready to do that? Do you have all your ducks in a row? The paperwork, are you have your list of assets, your contracts, assignable that you have, your IP, intellectual property, is that trademarked? Do we have all of that lined up? Your corporate documents, governance, officers, are your employees bound by employment agreements with restrictive covenants? So we want to kind of take an index of what we have currently and whether we need to do some cleanup work in order to position for sale. Because as you likely know, during any acquisition and due diligence, that's what a buyer is going to be looking for, and they want to look at your financials. Are they up to date? And so forth. So we got to position the company, make sure all the ducks in a row, the paperwork is there before we start sharing information. And then if you have a potential buyer, or you've got, a broker that's working on your behalf, the first step before any discussions take place is have a non-disclosure agreement executed between you and that potential buyer. That's number one. And then we can start sharing, information, and then move to like a letter of intent phase. So that's kind of the first initial steps. Seek out an attorney, seek out, an advisor of some sorts that does, M&A work, a financial advisor, as it may be, before you get too down the road and start looking at that. I've had a lot of clients get very excited and just think of a number, of a purchase price. I had one client not too long ago that someone approached him, threw out a number. He hadn't done his own homework, the seller, and agreed to the purchase price. And then we started discussing, and this was before I was involved, looking at his financials, also spoke with his accountant. It turns out the purchase valuation of the company was significantly more. And then we had to kind of unwind it, go back to the buyer and say, look, even though the letter of intent sets forth the material terms, it's non-binding. But we had to say, based on our review, it was a lowball number. We want to do a deal with you, but the number's got to be X, which is a couple million more. And they wanted to reevaluate, and they ultimately walked away. But the client was okay with that. And we had talked about that, knowing that he was going to get, a lowball offer. And so, he'll be able to sell it for his number when the time is right.
Yeah. I think one of the things that I've seen that, I haven't sold my businesses yet for a significant number. And that is going to come. I have one business right now that is a sellable business that eventually is going to sell, and it's going to be a nice situation. But I've always had the attitude that it's always great to build your business with the intent that at some point it's going to sell, because then you look at your business the right way, even from an operations standpoint. And in other words, is when you sell your business, are you going to want to go with that company, right? Probably not. Okay. And so that means that you need to build a business that is, after a certain revenue standpoint, where it's going on its own. right? Because the company that's buying you doesn't want to buy you.
Right.
Okay.
Right.
They're going to want you probably out or a transition period, right? So
Exactly.
your company becomes more valuable if it's able to be run, and also if it's able to run without key people, right? So I always felt that technology-based businesses, not even so technology, but companies that technology is doing the heavy lifting, where your lead generation program is in place. It's not you picking up the phone, making relationships, that you have the lead generation program in place. That's marketing. If you build the company with the idea of, hey, what will somebody want in my business? If I'm going to sell that, it just, even if you don't sell it, it makes your company more valuable. It makes it less harder on you to run your business. So that would be my advice as well. I mean, it's something that you would agree with.
Yes, absolutely, Stephen. Because a buyer, like you said, wants your assets and what you've built over all these years. And if you're the only person that can do everything and you don't have the technology to help run it, you're not, I mean, how are you going to sell it and get out if they need you to run the business? And there may be, a short transition period, but like you said, ultimately they want you out and they want you tied up with a non-compete, right? So you can't go start a new business and a non-solicitation, take all the customers otherwise, what is it they're buying, right? And so the company needs to stand on its own. And yes, there could be some goodwill associated with you individually. And you see that more in some professional practices, medical practices, law firms, financial advisors, accounting firms that I've worked with. But for other types of industries, technology, pharmaceutical, you know, IT, whatever, construction, the company's got to run on its own without you. Otherwise, it's not going to be that valuable to a buyer.
Let's talk about employment law. What is the number one thing that you see that small businesses get in trouble with in regards to employees?
Yeah. Not treating the employees fairly across the board and not offering the same kind of benefits. And it may not be done intentionally. And, look, I know I have clients and I know out there certain bosses, employers favor certain employees. Maybe some of the ones that are more higher performing have demonstrated a vested interest, but then might be another employee that's good, that shows up, but there's clearly kind of favorites being played. And that employee that it doesn't get that preferential treatment starts thinking, oh, something else is going on. They're discriminating against me. And so it's important to offer the same benefits across the board, treat everyone fairly across the board, whether it's time off, whether it's bonuses, whatever the policy in place is, it's got to be applied equally across the board. Another thing I see often is people don't give their employees employment agreements. It doesn't need to be an exhaustive, long agreement, but there should certainly be certain provisions in there, right? Whether it's an at-will employment, state that. Whether it's a term, the ability to terminate them without cause, meaning no reason, or for cause. And then also have restrictive covenants, confidentiality, a non-compete, a non-solicitation. And depending on the jurisdiction, those provisions need to be crafted certain ways in order to be enforceable. And tying that in with kind of a sale, like we were talking about, one of the things I've seen often is buyers want their employees to have employment agreements that have non-solicitation and non-competes. Number one is it protects the company and it protects the buyer. Like I said, if they're buying a company and all these employees can leave and start their own company, then what is a buyer buying? And then also it adds value to the company because these employees can't just leave and start their own company. So one of the biggest issues I see is employers don't have the necessary agreements in place for their employees. And, you got to be thinking, like you said, for a sale, that is one way to do it. Have your employees sign employment agreements.
What happens, and I agree with you, and I think it's, it's funny because it's really hard to go back once you have your team and then go back and say, oh, hey, I want you guys now to sign an employment agreement and a non-compete. It just causes lots of issues because it sends up a red flag. Like, why all of a sudden are you looking at this? Now you can give some answers like, well, listen, before we weren't really, I didn't know I needed this, and this is important. And everybody who's coming on board now has to sign this. I want to make sure we're consistent across the board. Those type of things. But what happens if you uh, have an employee who refuses to sign a non-compete agreement where you're getting everybody to sign? No, that wasn't my question. My question is, what happens if you have people who are coming on and you kind of get organized and you start saying, from now on, all the new people, they're going to have employment agreements, right? If you get that from those people, but then the other people who are working there now will not, you
Right.
don't get it from them, what happens?
Right. So that happens all the time, and it's an issue. Um, and it's not so much an issue from the new employees, it's the old ones that want to leave, or some issue happens, a dispute over something. And, there's certain common law rules, meaning, safeguarding confidential proprietary information, so that they'd still be bound by potentially a duty of confidentiality.
I didn't know there's common law like that.
Yeah,
Huh.
but it's what we call fiduciary duties. But the reality is, you're not going to be able to tie them up and prevent them from, soliciting a customer, or preventing them from competing with a company. And it's an issue. One way potentially around it, excuse me, like you said, is maybe offering them a bonus, right, in exchange for signing it, if that person is truly valuable to you. Typically, we see that if it's like a sales and account representative, or a salesperson of some sort that really has the one-to-one, boots on the ground relationship with your customers, and that you could be significantly damaged if you leave. That may be worthwhile saying, hey, I'll give you a bonus of X dollars if you sign this, to tie them up. Now, they may still refuse. And, that's a business decision you'll need to make as to whether you do them. You could theoretically, if they're at will employees, have the right to terminate them. But if you terminate them, then you don't have a restrictive covenant, and they could leave and take your employees and can be damaged. So you got to think through how we deal with that situation, paying them, terminating them, and there's different avenues to pursue.
How many times should a small business owner, we're talking like $3-5 million in revenue, be in contact with their attorney?
Sure. I would say, once a quarter, to check in, have an update. Maybe they've acquired a business and didn't even tell you, or brought on a partner. I can't tell you how many times they'll say, hey, oh, by the way, I don't think I ever told you, but a couple months ago, I brought in this partner. And I say, well, how'd that happen? How did he get his stock or his ownership interest? We got to document that. Did we think through that? So I'd say once a quarter, that would cover it. And then as needed, if issues arise, whether it's a change in ownership, there could be a payment dispute depending on the nature of the industry, an employee. So it's good to just kind of check in quarterly, I think.
I know with my own attorney, and I do have a couple of them depending on the situation, but I always look at it like, so they always make sure I have, like, I don't know if it's board meeting notes or, yearly
Right.
documents to show that, I don't know, you tell me. I don't know.
Yeah.
What is what the
Yeah.
name
It's the
now?
corporate minutes. So when you're a corporation, on an annual basis, you're supposed to have kind of an election of officers and directors and approve other corporate actions, whether it's a line of credit you took out, a new lease, and approve compensation. But let's be real here. All business owners are busy running their day-to-day business, doing their thing. They're not thinking about these kind of corporate minutes. And so what happens is there will be an event that something happens, whether it's a bank, big old bank for a loan or a line of credit. The bank's going to ask for your minutes and corporate documents. And so a lot of times clients will say, Andrew, I haven't done that. Can you help me out? And so we'll prepare what's called catch-up minutes, right? And so that we'll approve actions for the last couple of years, try and figure out when the last time you did corporate minutes, have the election for the new officers, directors, and go through if there's been any kind of major corporate changes, approve issuance of stock if need be, approve an acquisition of a company, bringing on a partner, and so forth. And so that can be that year's corporate minutes and kind of catch up, bring to forward what's happened in the last couple of years.
Now, what happens if you don't do that?
Nothing. You don't get into trouble. There's no agency that says, oh my God, Stephen, you didn't do that. You're going to be fine. But it's part of good management of your business, keeping your corporate records, up to date. It's important to have it. And that's part of kind of the sale part, right? Having things lined up and ready to go when you are prepared to sell. And so you can do that cleanup at that time. But it's important to do it. But at the end of the day, no one's going to sue you over that. You're not going to be fined by anybody. But it's important when you do have partners to do it. So everyone knows, we approve this action at this period of time. And these are current officers and directors and current stockholders.
Tell me the top one or two things that you've seen issues with taxes.
Yes.
With business owners.
So biggest one is people just not filing their taxes. You would be amazed how many successful business owners I've worked with and know of that just don't pay their taxes. And, depending on the type of industry, it could be a single member LLC. So that's typically filed on their Schedule C, so their personal tax return. And so they may not report all of the income, or partnerships, and it always amazes me. They just don't file. At a federal level and a state level. And it gets tricky at a state level. And I see it more often at a state level that people just didn't know they needed to file, an annual franchise tax, for example, in the District of Columbia, or a corporation tax. They just file their federal, partnership 1065. And so that would be the biggest one. And then the other one would be the Schedule K1s, issuing to their shareholder or their members in an LLC. So most people need that, or not most, everyone needs that to report on their own individual return. So the company needs to, typically by end of March each year, issue to all the members their Schedule K1s.
Okay. So last thoughts on the things that you've noticed the most that business owners that, over $1 million, over $3 million, under 10 million are, really need to be careful of.
Yeah. I think depending on the nature of industry, having contracts in place with your clients and customers, and, that talks about when you're going to get paid, what happens if you don't get paid. Is there an attorney's fees provision so that when you do need to come to a lawyer and say, John Doe ABC LLC hasn't paid me, I'm going to say, well, first thing I'm going to do is let me look at your contract. What rights and remedies do you have in your contract to go after them and understand why they haven't paid? And so the big kind of overarching thought here is have contracts in place that provide you with remedies, or limitation liability. If you're providing services as a consultant, you want to limit your exposure to your client and customer. And how do we do that? Through indemnifications, limitation liabilities, and so forth.
Yeah, you brought up some really good points here. And I just remember that. So the difference between my first company and my seventh company, it's like the difference between day and night. And that is, I get in there, I really don't know what I'm doing. Employment contracts, client contracts, setting up the right type of corporation, doing all these things, and you just kind of plow forward, right? But the thing that I learned over a period of time is you having a great lawyer who has lots of experience in working with business owners, having a great accountant who has lots of experience working in tax matters or working with business owners. I'm trying to think of some other potential advisors, a mentor, potentially someone who's got lots of experience in running a business. You just going to them and saying, this is what my business does. This is how it works. Share with them. Don't even ask them don't even wait for your lawyer, for your accountant or your mentor or whoever to ask questions about how your business works. Explain that to them. Tell them in detail I mean, I know it costs money, okay, because you're asking them for their time, especially when it comes to the lawyer. It's worth that hour or two for them to understand your business. And then the next question you have is, what should I be doing that you see other business owners doing, and why? And I think because that way you can use their experience, because the value that a lawyer, an accountant, or a mentor has is that they're not in a silo like you are. Your silo is your business, but they're seeing tons and tons and tons of other businesses. So they see it all. And that experience that they bring to the table, to me, is what you're paying them the money for. And so I think that's a good thing for you to do, is go back to your lawyer, go back to your accountant, go back to your mentors and say, this is how my business is running. This is where we are financially. What type of problems should I be worried about coming forward? What type of things should I be doing now? Andrew, would you agree with that type of assessment?
Absolutely. Absolutely. That's the value that the professional advisors can bring is, it's important for us. And the most important thing I try and do is put my my feet in my client's
Yeah.
shoes,
Yeah.
understand their business. And only by understanding their business is then I can advise them. And, based on my experience, and like you said, a lot of us have seen it all. And so we know the pitfalls. We know the issues that are likely to come up that they haven't even thought of.
Yep.
And so the key is, how do we prevent that happening to them? And what do we got to do that? And that's the key.
Yeah, I would also say too, it's a little less different with I think it's important for all of the people I mentioned, the lawyers, the accountants, and your mentors. Sometimes business is just rolling and you don't talk to them much. You mentioned that you should probably talk to your lawyer on a quarterly basis. I think you should be talking to at least everybody on a yearly basis and letting them know what's going on in your business. Like your accountant will only know what's going on from the financial standpoint, but maybe you're looking into going into another line of business. Maybe you're looking into going after another market. Maybe you're looking and working in a different state. You know, tell your professionals that you work with what's coming down the track, what went on, what's going to go forward. And I think that's, especially with the lawyer, because sometimes you don't need to kind of bring your lawyer sometimes in until there's a problem, and sometimes you don't have any problems in your business. But if you've gone from 3 employees to 20 employees, probably a good idea to say to your lawyer, hey, I did that. I went from 15 employees to 110, right? And so we needed to get things buttoned up when it came to employment practices. So especially because I had an employment lawyer who specialized in that, because it was a complicated business when it came to employment stuff. So, Andrew, any other last thoughts before we wrap it up for today?
No, I think you hit everything. The key, I would just remind, all the listeners, is talk to your advisors, keep them informed as what's going on, because they can only help you when they know, and you shouldn't assume that they know what's going on with your business. And it's important to be proactive and preventive in order to avoid any of the horror stories you may have heard from other friends and family in business.
Good. Very good. So I'd like to thank so very much for Andrew Schwartz from Stein, Sperling, for coming on to today's podcast. If you like today's podcast, please feel free to share it with a friend, and also subscribe on your favorite podcasting app. Please also give us a review. It really helps us get the word out. They use that as the algorithm to determine where we rank. And, we're in the top 5% of the podcasts for entrepreneurship. So we're proud of that. And if you're looking for a line of credit for your business, please give us a call at 862-207-4118 or visit our website at fscreditline.com. That's FS as in Financing Solutions, creditline.com. Andrew, if anyone wants to get in touch with you, how would they go about doing that?
Yes, they can visit our website at Stein, Stein, Sperling, Sperling.com, steinsperling.com. They can also reach me at 301-838-3327. That is my direct number. And also email me at aschwartz@steinsperling.com, aschwartz@steinsperling.com.
Very good. Thanks for coming on.
Thank you for having me.
So just as a wrap up, I think I'm going to reiterate something that I said toward the end, and is bring your employer, accountant, and mentors more into your business. Let them know what's going on. Pick their brains. They've been there before. They'll help you in the future. Have a great day, everybody.